Hi there, my name is Jamal Khan. I'm a senior tax partner at Churchill Tax Advisors. Today's topic is quite topical in current circumstances with COVID-19, and we're talking about inheritance tax. Inheritance tax implications for people who are affected by COVID-19. First of all, we want to talk about claims made for overpaid inheritance tax, where somebody has lost their relatives in the last year or so, and firstly, if the deceased left back any left any properties, and if the properties were valued at a particular level, for example, £1 million at the date of death, and the inheritance tax is normally paid within 6 months of the date of death. If that property is sold within 4 years, and the property is sold at a loss, which is a value that is lower than the date of death, then you can potentially claim back any inheritance tax, excess inheritance tax that was paid. So that is for properties. The second one is for stock market shares, where the deceased left behind some stock market shares, and the property value the value of the shares, has decreased within the 12 months since the date of death, and the shares are sold at a loss within those 12 months. Then you can potentially claim back any overpaid inheritance tax on those shares. That's very important. So if you've lost somebody in your families, and due to the current recession that we're going through, or crisis that we're going through, if the values of the stock market shares of the properties have gone down and the properties are being sold, or shares are being sold, then you can potentially get some refunds for inheritance tax. The next point I've been asked very regularly by potential clients or our clients in the last few weeks is a review of the family assets and the wills. Very important. If your family has an estate worth more than £1 million, you should be speaking to a tax specialist and carry out an urgent review of your estate, see what can be done, if there's any potential areas to avoid, so that steps can be taken now to avoid or mitigate an inheritance tax. Especially if you have a mirror will. Mirror wills are a temporary solution, but on a long-term basis, mirror wills can be very problematic, and the resultant tax liability can be substantial. The deed of variation is another one. So if you've had deaths in the family recently, you and the deceased left behind a will, and if the person passed away within the last 2 years, so you have 2 years to vary somebody's will and make it more tax efficient. That can potentially save a lot of inheritance tax that can be paid. So what we're asking clients, is to contact us as soon as possible, and make sure that a specialist reviews the will and checks any scope for any variation within the 2-year period. The last point that I would like to talk about today is Bereaved Minors Trust. Now, this is a very effective form of tax planning, and is applicable where somebody leaves behind young minor children under the age of 18. And if young parents pass away and leaves behind young children, they can leave the assets as part of their will. So Bereaved Minors Trust goes into your will, into a Bereaved Minors Trust, which means there's no inheritance tax to pay at all. And the capital and income from the Bereaved Minors Trusts can be used to apply for the maintenance of the children until they reach the age of 18, at which stage the trust capital and assets pass on to the child. But this is an effective way of completely avoiding inheritance tax. If you have any questions, please give us a call. or visit our website, churchilltaxadvisors.co.uk. Thank you very much.